I just read and read and read. I probably read 5 to 6 hours a day. I don't read as fast now as when I was younger, but I read every book in the Omaha Public Library. And this was by the time I was 11, and we moved back here. And as soon as I got back here and my dad was in Congress, I said, get everything in this Library of Congress. I want to read it.
But I will say this, I know no wise person who doesn't read a lot.
Today, we are going to talk about 11 books that Warren Buffett recommends every investor must read. First, quick side note, did you guys know Buffett's full name is Warren Edward Buffett? I've been following him for a while, and I just learned his middle name. Comment down below if you actually knew his middle name. Anyways, back to the video. You might ask, how do we know that Buffett actually recommended all the books in this list? Well, as most of you might already know, Buffett is an avid reader himself. He spends 80% of his day reading, so whenever he finds an exceptional book, he usually shares it through his shareholders' letters or at his annual meetings. So let's jump right into what these books are. Common Stocks and Uncommon Profits by Philip A. Fisher. Widely respected and admired, Philip Fisher is among the most influential investors of all time. His investment philosophies, introduced almost 40 years ago, are not only studied and applied by today's financiers and investors, but are also regarded by many as gospel. His book, Common Stocks and Uncommon Profits, published in 1958, devotes careful attention to this concept of networking and gathering information via business contacts. Fisher recommended targeting businesses for investment that had growth orientation, high profit margins, high return on capital, a commitment to research and development, a superior sales organization, a leading industry position, and proprietary products or services. He was famous for the depth of his research on companies with which he would invest. He relied on personal connections, what he called the business grapevine, and conversation to learn about businesses before buying stock. Warren Buffett said, "A thorough understanding of the business, obtained by using Phil's techniques, enables one to make intelligent investment commitments." Business Adventures, 12 Classic Tales from the World of Wall Street by John Brooks. Not long after Microsoft Corporation co-founder Bill Gates first met Mr. Buffett back in 1991, Mr. Gates asked the Oracle of Omaha to recommend his favorite book about business. As Mr. Gates recounted, Mr. Buffett didn't miss a beat before naming this, a collection of New Yorker articles from the 1960s. The book contains notable and fascinating accounts of some of the largest companies of the mid-1900s that are as relevant today to understanding the intricacies of corporate life as they were when the events happened. Stories about Wall Street are infused with drama and adventure and reveal the machinations and volatile nature of the world of finance. John Brooks' insightful reportage is so full of personality and critical detail that whether he is looking at the astounding market crash of 1962, the collapse of a well-known brokerage firm, or the bold attempt by American bankers to save the British pound, one gets the sense that history really does repeat itself. Where Are the Customers' Yachts? By Fred Schwed. Another decades-old classic, this book uses humor to pierce some of the pretensions of Wall Street. The title comes from the story of a visitor to New York who was admiring all the nice boats in the harbor and was told that they belonged to Wall Street bankers. He naively asked where the bankers' clients kept their boats. The answer, they couldn't afford them. Mr. Buffett once called it the funniest book ever written about investing and said it lightly delivers many truly important messages on the subject. Full of wise, contrarian advice and offering a true look at the world of investing, in which brokers get rich while their customers go broke, this book continues to open the eyes of investors to the reality of Wall Street. A light, fun read and something you definitely want to pick up to have a laugh, and more importantly, learn about the world of brokers and managers so you don't lose out on your money. Essays in Persuasion by John Maynard Keynes. Essays in Persuasion, written by legendary author John Maynard Keynes, is widely considered to be one of the top 100 greatest books of all time. The essays in this volume show Keynes' attempts to influence the course of events by public persuasion over the period of 1919 to 40. With startling accuracy, Keynes forecast the economic fluctuations that were to beset the economies of Europe and the United States, and even proposed measures which, if heeded at the time, might have warded off an era of worldwide depression. His views on Soviet Russia, on the decline of laissez-faire and the possibilities of economic growth are as relevant today as when Keynes originally set them forth. Mr. Buffett has flagged this collection of writings from the noted economist both for the importance of its ideas and the clear way they're presented. While Mr. Keynes is now known, and in some quarters vilified, for his work as an economist, he also devoted a fair amount of time to stock picking. Mr. Buffett has deemed him brilliant at both callings. Reading Keynes will make you smarter about securities and markets, he told Outstanding Investor Digest in 1989. I'm not sure reading most economists would do the same. The Little Book of Common Sense Investing by Jack Bogle. Jack Bogle, the CEO of the Vanguard Group, is a prolific investor best known for creating the first index fund. An author of multiple books, The Little Book of Common Sense Investing is probably his most famous work. In a time when everyone tried to beat the market with great stock picks and then charge expensive fees for it, he thought, why not just mimic what the indexes are doing and not manage anything? This little thought turned into one of the most prevailing investment ideas of the following century, and one of the most respected investment companies in the world. The book shows you an alternative to actively, poorly managed, overpaid funds by introducing you to low-cost, passive index funds as a sustainable investing strategy, which gets you the retirement savings you need without the usual hassle of stock investing. He claims that the majority of your money is best invested in safe, low-cost index funds, and you can't go wrong by just choosing the cheapest index fund. For the record, Mr. Buffett himself has frequently said most investors are better off buying low-cost index funds. Poor Charlie's Almanac, The Wit and Wisdom of Charles T. Munger, edited by Peter Kaufman. This is a book very close to Mr. Buffett. It comes from Charles Munger, the vice president of Berkshire Hathaway, a man Warren Buffett described as his closest partner and right-hand man. Mr. Buffett hasn't been shy about attributing much of Berkshire's success to his right-hand man, in no small part for saying no to some of Mr. Buffett's stupider ideas. Mr. Munger is a deep thinker on human behavior and human frailties, and has spoken often about how investors can shoot themselves in the foot. This book is a biography that chronicles Charlie's growth from his humble Omaha childhood to his phenomenal financial success. His Midwest values prepared him well for his long, illustrious journey. The book also summarizes his approach to life, decision-making, learning, and investing. It talks about his unconventional method of thinking and his astonishing work ethic, that is, the twin fonts of his remarkable success. There is a special Mungerisms Charlie Unscripted section that holds a collection of scathing remarks he had made at previous Wesco Financial and Berkshire Hathaway annual meetings. This book also includes the talks and speeches that he had given in a specific 20-year period. The book not only will help you with direct tips on investment, but reading through Mr. Munger's experiences will definitely help you hone your investing skills and to identify better investments. The Intelligent Investor by Benjamin Graham. If you're watching this video, I am 100% sure you already know this book. It's considered the Bible of investing, the book that started it all for Buffett. A classic on the basics of value investing, Warren Buffett once said about the book, "Picking up that book was one of the luckiest moments in my life." After reading it, Mr. Buffett enrolled in Columbia University so he could take classes from Mr. Graham, and later went on to work for him. Even now, when asked a question about his approach to investing, Mr. Buffett is liable to cite specific chapters from the book. The book teaches readers strategies on how to successfully use value investing in the stock market. The Intelligent Investor is notable today, with many famous investors praising it for helping them learn how to determine value in the stock market and successfully pick stocks for their portfolios. Graham's main investment approach outlined in The Intelligent Investor is that of value investing. Value investing is an investment strategy that targets undervalued stocks of companies that have the capabilities as businesses to perform well in the long run. Value investing is not concerned with short-term trends in the market or daily movements of stocks. This is because value investing strategies believe the market overreacts to price changes in the short term without taking into account a company's fundamentals for long-term growth. In its most basic terms, value investing is based on the premise that if you know the true value of a stock, then you can save lots of money if you can buy that stock on sale. This book is an absolute must-read for starters to understand how to truly evaluate the market and not be swayed by trends. The Most Important Thing, Uncommon Sense for the Thoughtful Investor by Howard Marks. Howard Stanley Marks is an American investor and writer. He is the co-founder and co-chairman of Oak Tree Capital Management, the largest investor in distressed securities worldwide. The most important thing explains the keys to successful investment and the pitfalls that can destroy capital or ruin a career. Utilizing passages from his memos to illustrate his ideas, Marx teaches by example, detailing the development of an investment philosophy that fully acknowledges the complexities of investing and the perils of the financial world. Brilliantly applying insight to today's volatile markets, Marx offers a volume that is part memoir, part creed, with a number of broad takeaways. Marx expounds on such concepts as second-level thinking, the price-value relationship, patient opportunism, and defensive investing. Frankly and honestly assessing his own decisions and occasional missteps, he provides valuable lessons for critical thinking, risk assessment, and investment strategy. In today's post-pandemic global market where companies are still finding their footing, these are important values to find a solid investment. The Outsiders by William Thorndike Jr. A book that was #1 on Warren Buffett's recommended reading list on the Berkshire Hathaway Annual Shareholder Letter 2012, The Outsiders details the extraordinary success of CEOs who took a radically different approach to corporate management. In this refreshing, counterintuitive book, author Will Thorndike brings to bear the analytical wisdom of a successful career in investing, closely evaluating the performance of companies and their leaders. Thorndike talks about 8 individualistic CEOs whose firms' average returns outperform the S&P 500 by a factor of 20. In other words, an investment of $10,000 with each of these CEOs, on average, would have been worth over $1.5 million 25 years later. Some of the companies on this list are highly recognizable names like the Washington Post Company, Berkshire Hathaway, General Dynamics, and more. Humble, unassuming, and often frugal, these outsiders shunned Wall Street and the press, and shied away from the hottest new management trends. The book is a must-read to learn the traits and methods, striking for their consistency and relentless rationality, that helped these unique leaders achieve such exceptional performance. The Clash of the Cultures, Investment versus Speculation. This is another book from Buffett's 2012 letter. In this book, legendary investor John Bogle talks about the changing culture in the mutual fund industry. For regular investors like you and I, Bogle shares his list of 10 simple rules of common sense investing. According to Bogle, it may not be the best strategy ever devised, but the number of strategies that are worse is infinite. Dream Big by Christian Correa. This book was originally published in Portuguese, and after Buffett's recommendation, English copies of the book were virtually sold out from every store. In this book, author shares the story of the Brazilian trio behind 3G Capital, the private equity firm that owns Anheuser-Busch InBev and has partnered with Berkshire on deals to acquire H.J. Heinz and Kraft Foods Group Inc. While Berkshire's partnerships with the firm are recent, Mr. Buffett's relationship with 3G's Jorge Paulo Lemann go back for years. My friend and now partner, Jorge Paulo, and his team are among the best businessmen in the world, Mr. Buffett said. He is a fantastic person and his story should be an inspiration to everybody, as it is for me. That's it for today. Smash that like button if you enjoyed the video.
Anyone who follows Warren Buffett knows that he has avoided technology stocks throughout his entire investing career. He has repeatedly said that the rate of innovation inherent in technology companies makes it difficult for him to reasonably estimate the operating future of the company with a high probability. That is why it came as a surprise to many in the finance community when Buffett decided to buy Apple stock in 2016, first buying 10 million shares of the company. He has since gone on to add to that stake, eventually investing more than $36 billion in the tech company's shares. That stake, including the $11 billion in shares he has cashed in last year and the over $3 billion that Berkshire has collected in dividends, was worth about $134 billion at the end of 2020. This means that Berkshire has made nearly $100 billion on its stake in the company. Apple shares have slid slightly in 2021, but are still up an impressive 400% in the past 5 years. Berkshire now owns just over 5% of Apple, which currently has a market value of greater than $2 trillion, making it Buffett's largest investment in any publicly traded company. At $120 billion, Berkshire's stake in Apple equals about 40% of its overall stock market portfolio. Buffett is quick to point out that he considers Apple more of a consumer goods company as opposed to a pure technology company. Buffett is a big fan of companies with strong brands and loyal customers. Apple fits that description pretty well. 3 years ago, Buffett told CNBC that he believes the average person's connection to the iPhone was strong enough that most people would pay much more for the device than they currently do. I focus on the hundreds of millions of people who practically live their lives by the iPhone, Buffett said at the time. I have a plane that costs me a lot, $1 million a year or something of the sort. If I use the iPhone like all of my friends do, I'd rather give up the plane than the iPhone. Another key criteria that is important to Buffett in his investing approach is that he focuses on the quality of the management. He wants a management team and CEO that is focused on creating long-term shareholder value. Prior to making his investment, Buffett said he never spoke to Apple's CEO, Tim Cook. However, he frequently read Apple's annual report and 10K to truly understand the company and how Tim Cook ran the company. Buffett has been very complimentary of Tim Cook, saying Tim understands the world to a degree that very, very few CEOs I've met over the past 60 years could match. That is very impressive coming from Buffett, who has met some of the best CEOs in the world over his long and storied investing career. Take a listen to Buffett talk about Tim Cook in this clip.
In his own way, it's a different way, but Tim Cook is, we see a lot of managers of a lot of businesses, and you're looking at two great ones on both ends here. He's handled that business so well. He couldn't do what Steve Jobs obviously could do in terms of creation, but but Steve Jobs couldn't really, I don't think, do what Tim Cook has done in many respects.
Next on the list is Geico, which stands for the Government Employees Insurance Company. It is now a wholly owned business of Berkshire Hathaway, but it wasn't always that way. In fact, Buffett's history with Geico goes all the way back to the 1950s, even before he owned Berkshire Hathaway. Geico first came across Buffett's radar when he was still a business school student at Columbia under his professor and future employer, Benjamin Graham. In 1951, Buffett went down to Geico's offices on a Saturday, where the janitor let him in. The only other person working that day was Lorimer Davidson, who would later become the CEO of the company. Davidson agreed to meet with Buffett and generously explained that both the insurance industry and Geico's special competitive advantages. Geico was set up in a unique way for an insurance company, bypassing traditional agents to sell policies directly to consumers. In addition, Geico targeted only high-quality drivers such as government bureaucrats and professors. By selecting its market segment and not having to pay agents commissions, Geico was able to offer car insurance at a huge discount to other insurers while still earning a superior profit margin. Never being much of a fan of portfolio diversification, Buffett subsequently put half of his net worth into Geico stock. Buffett would make a quick 50% return in just over a year before selling his Geico stake to put the profits into a cheaper stock. That would prove to be a mistake, as the value of Geico stock rose nearly 100 times over the next 20 years. That taught me a lesson about the inadvisability of selling a stake in a wonderful company, Buffett said in his 1995 letter to shareholders. However, 25 years later, Buffett got another chance to buy Geico, this time acquiring Geico stock for his holding company, Berkshire Hathaway. In a stunning turn of events for such a competitively advantaged company, Geico almost went bankrupt in 1976. By then, Davidson had retired, and the new executives running the company started to vastly underestimate Geico's claimed losses resulting from inflation. They then tried to fix the problem by growing out of it, relaxing the company's premium to surplus ratio, or the amount of premiums in relation to equity, and growing out of its niche business of high-quality drivers. That only wound up making things worse for the company. Losses soon grew, and by 1976, Geico was on the edge of bankruptcy. By then, Buffett was on the board of directors, having taken over from Jerry Newman, partner in the Graham-Newman partnership, which had been a large investor in the company. Buffett then helped recruit a new CEO to come and fix the mess. With the belief in the new CEO's abilities and Geico's main competitive advantages still being intact, Buffett pounced on Geico's distressed share price, buying $4 million in Geico common shares and another $19 million in convertible preferred stock. Once installed, the new CEO took emergency measures, firing over half the company's employees, exiting unprofitable markets, and raising premium prices. These actions worked, restoring Geico's profitability in the very next year, and Buffett's investment was off to the races. By the end of 1977, Buffett's common stock had increased 150%, and even the value of the preferred stock had nearly doubled. Buffett added even more to his Geico holdings over the next 4 years, and by 1980, he had invested $45.7 million in total, good for roughly 1/3 of the company. With Geico restored to its former glory and its low-cost advantage intact, Geico continued to both grow and buy back stock throughout the 1980s, which increased Berkshire's ownership stake to 50% of the company without a need for Buffett to buy any more stock himself. At the end of 1995, Berkshire bought out the remaining 49% that it didn't already own for $2.3 billion. That meant Berkshire's initial $45 million stake had grown to be worth a stunning $2.4 billion at the end of 1995, just before the deal closed. Good for a ridiculous 5,000% gain in just over 15 years. That's over a 30% annualized return starting from 1980 when Buffett attained his full stake. From 1976 on, the return was even higher. Today, Geico is one of the most important subsidiary companies of Berkshire Hathaway, with some estimating the value of the business at over $30 billion. Third on the list is BNSF, arguably one of my favorite Buffett investments of all time. In 2009, Buffett's Berkshire Hathaway bought the remaining 77% of Burlington Northern Santa Fe, the nation's second largest railroad, that it did not already own, in a deal worth $44 billion. Buffett started purchasing shares of the company in 2007 and had built up a stake of over 20% of the company before he decided to purchase the remaining shares and the entirety of the company. Buffett considered this purchase an all-out bet on the future of America. One of 9 North American Class 1 railroads, BNSF has 41,000 employees, 32,500 miles of track in 28 states, and more than 8,000 locomotives. It has 3 transcontinental routes that provide rail connections between the western and eastern United States. BNSF and its chief competitor, the Union Pacific Railroad, have a duopoly on all transcontinental freight lines in the western U.S. and share trackage rights over thousands of miles of track. Buffett liked BNSF so much that he did something that he strongly dislikes and rarely does: issue stock in Berkshire Hathaway to fund an acquisition. The total consideration consisted of $15.9 billion in cash and $10.6 billion of newly issued Berkshire common stock. Berkshire raised approximately $8 billion in debt at the corporate level to fund the cash component of the transaction, along with an equivalent amount of cash on hand. In the 2009 Berkshire Hathaway annual report, Buffett said, "In the end, Charlie and I decided that the disadvantage of paying 30% of the price through stock was offset by the opportunity the acquisition gave us to deploy $22 billion of cash in a business we understood and liked for the long term." Warren Buffett has frequently said that his favorite holding period for an investment is forever, so it should come as no surprise why he would like a railroad. BNSF's history dates back to 1849. The railroad has been in business for more than 150 years and will likely still be in business 150 years from now. While shifting consumer preferences and technological advancements will change what products and materials the railroad will be moving, you can count on the railroad will still be used to move whatever products and commodities are needed by consumers and the economy at that point in time. While BNSF is a wholly owned subsidiary of Berkshire Hathaway and no longer trades separately on an exchange, some analysts' estimates have assigned a value of nearly $200 billion for BNSF. This is nearly 5 times what Buffett paid for the company just over a decade ago. BNSF's biggest competitor, Union Pacific, has a market cap just shy of $150 billion as of the production of this video. The reason why I like this investment is the simplicity of the business model. It doesn't take a genius to really understand the economics of a large railroad. Even with that being said, Buffett had the ability to focus on the long term and buy a great asset at a discount with this investment. That decision has paid off well, with the estimated return of this investment easily over $100 billion. Next up on the list is See's Candies. While this investment hasn't brought in tens of billions of dollars for Buffett, like his investments in companies such as Apple, Geico, and BNSF, Buffett's investment in See's Candies has had quite an impressive return on a percentage basis. Berkshire acquired See's Candy in 1972 for $25 million. In today's money, that'd be worth just under $155 million. See's Candies is an American manufacturer and distributor of candy, particularly chocolates. At the time, See's was earning around $4 million annually before tax, just under $25 million in today's dollars. So Buffett and Munger paid roughly 6.25 times earnings for the business. They were essentially betting that See's Candy would continue to be profitable, if not more, 10 years down the line. Fortunately, that bet paid off. By 2017, the business had earned Berkshire around $2 billion, or 80 times the money that it had been acquired for. Arguably more important than the money See's Candy has made Buffett is the lessons it taught him. Prior to buying See's Candies, Buffett was known for his cigar butt approach to investing, where he would buy struggling companies that were selling so cheaply that he could make money on the investment as the company was liquidated. Buffett compared this approach to cigar butts, where if you pick up a discarded cigar butt on the street, you would only get one puff left of it, but at least that would be free. The See's Candy investment marked a turning point for Buffett, where he transitioned from buying poor businesses at a great price to buying great businesses at a fair price that could compound returns for decades. See's is the epitome of that kind of business. Listen to this clip of Warren describe the economic characteristics of the business.
You can go back to the first, wasn't the first outstanding business we bought, but it was kind of a watershed event, which was a relatively small company, See's Candy. And the question when we looked at See's Candy in 1972 was, would people still want to be both eating and giving away that candy in preference to other candies? And it wouldn't be a question of people buying candy for the low bid. And we had a manager we liked very much, and we bought a business that was paid $25 million for it net of cash, and it was earning about $4 million pre-tax then, and we must be getting close to $2 billion or something like that pre-tax that we've taken out of it. But it was only because we felt that people would not be buying necessarily a lower price candy. I mean, it does not work very well if you go to your wife or your girlfriend on Valentine's Day, I hope they're the same person, and say, here's a box of candy, honey, I took the low bid. It loses a little as you go through that speech. And we made a judgment about See's Candy that it would be special, and probably not in the year 2017, but we certainly thought it would be special in 1982 and 1992, and fortunately we were right on it. And we're looking for more See's Candies, only a lot bigger.
Selling candy is a pretty straightforward business, which makes See's the perfect example of Buffett and Munger's core beliefs, that investing is about putting some amount of money down today in order to secure a larger amount of money in the future. It is interesting to note that Berkshire almost missed out on See's Candies. Buffett said at the 2017 conference that he wouldn't have paid much more than the $25 million for it back in 1972, although he is quick to point out that his business partner, Charlie Munger, would have, remarking, "If it had been $5 million more, I wouldn't have bought it." Of course, with the benefit of hindsight, paying $5 million back in 1972 for a cumulative total return of $2 billion in earnings by 2017 would have been a no-brainer decision. Number 5 on the list is Coca-Cola. Warren Buffett may be best known for his investment in Coca-Cola, one of the most iconic brands in the world. He bought more than $1 billion in Coca-Cola shares in 1988, an amount that was equivalent to 6.2% of the overall company. The purchase made it the single largest position in Buffett's Berkshire Hathaway portfolio at the time. While Berkshire's portfolio of companies has grown substantially since the 1988 purchase, Coca-Cola remains one of the largest positions in Berkshire's portfolio, more than 30 years later. The position is currently worth nearly $22 billion. But what made Buffett buy the stock when the stock was still reeling after the 1987 market crash? And why has he held on for so long? The stock market crash of 1987 created some attractive opportunities for long-term oriented investors, as all stocks were sold off with little regard to their fundamentals. Coca-Cola was an example. It was, and still is, the dominant company in the beverage industry. With over 500 unique brands selling in nearly every country of the world, it is truly a global company. Coca-Cola's iconic name, strong brand recognition, and global reach create a moat around its core soft drink product. A successful consumer-facing business builds the name recognition, the distributor network, and the retail relationships that protect it from encroachment by competitors. Buffett understood that no competitor was going to appear and take away Coca-Cola's market share and dominant competitive advantage. Coca-Cola's moat has continued to expand over the years as the company has steadily absorbed potential competitors and expanded into new trends through purchases such as vitamin water, green tea, and Dasani waters. Listen to Buffett describe Coca-Cola's brand power and his investment rationale in this clip.
Coca-Cola sells half, roughly, of the soft drinks in the world, and soft drink consumption per capita goes up basically every year, and the per capitas go up. I mean, the capitas go up every year also. So you get these gains. Maybe they're 3% or 5% in units or 4%. It was 5% in the first quarter, but it was poorer than that. I think it was 3% last year. But when you have half the world, and the world's population is growing at a little under 2%, and you're getting 3 or 4% from something that's as pervasive as soft drinks, you're doing all right.
Buffett's investment in Coca-Cola also demonstrates the power of one of Buffett's favorite investing concepts, share repurchases. Over the ensuing decade since his initial investment, Coca-Cola has used the cash the business has produced not only to pay healthy dividends, but also buy back stock and reduce the number of shares outstanding. This means that there are less shares outstanding of the company, and as a result, each share represents a larger ownership percentage of the company. This is the reason Buffett's original 6.2% stake in Coca-Cola has grown to 9.3% without purchasing any additional shares. Berkshire is now the single largest shareholder in Coca-Cola. It's safe to assume Buffett won't be selling anytime soon. So there we have it. These 5 investments helped Buffett produce over $200 billion in returns. What are the key takeaways we should learn from these investments? There are many, but here are my 3 favorites. 1. Focus on the long term. 2. Truly understand the economics of the business you are investing in. And 3. Buy businesses with strong competitive advantages. Thank you for watching. I hope you found the information useful and relevant. Talk to you soon.